Very good evening and welcome. You're watching live session on the economic outlook for India, powered by Investonomics, an initiative by ICICI Securities. Those of you who are watching this live, please do subscribe to our YouTube channel. Also, you can post your queries in the comment section below, and we will try and take some of your questions live towards the end of this session. Joining me now is Mr. P.K. Basu, Chief Economist at ICICI Securities. Very good evening, Mr. Basu, and thank you so much for joining in.
Good evening, Geetu. Good to be here again.
Our pleasure, sir. Let's talk about the latest report of IMF. It has lowered the growth projection for India to 5.9%. World Bank too has slashed FY24 GDP growth forecast for India to 6.3 from 6.6 earlier. Advanced economies are expected to see a pronounced growth slowdown from 2.7% in 2022 to 1.3% in 2023. So what are the key factors, Mr. Basu, that you think will help India to really outshine the world out there?
Well, even the IMF forecasts that India will be the fastest growing large economy in the world. Among the G20 economies, India will be the fastest growing this year, as it was last year, and is also expected to be the fastest growing in 2024 calendar year. So I think the 5.9% forecast is ludicrously low, and I think India will do quite a bit better than that. In fact, even for the last fiscal year, which has just ended recently, but for which we don't have the final numbers yet, I think India is going to see real GDP growth of 7.3%, primarily because the fourth quarter saw a pickup in industrial output, which was a substantial acceleration from the previous 6 months. And so the fourth quarter real GDP is likely to be above 6%, which will take full year FY23 real GDP growth to 7.3%. Now, in the year ahead, that is this fiscal year 24, I think the turnaround that we've seen in fixed investment spending is going to continue to gather momentum.
Okay.
In the last couple of months, we've also seen consumer non-durables output picking up, and that is a sign of a strong turnaround in rural consumption. If you look at consumer non-durables, they were weak for 2 years. And in fact, they were contracting slightly for 2 years. And then in the last 2 months, January, February, we've seen growth in double digits, year-on-year growth in double digits for consumer non-durables. The RBI estimates that the Rabi crop, which is now being harvested, the Rabi crop is likely to be up 6.2% year-on-year. That's extraordinarily strong. Normally, the agriculture crop in India grows 3 or 4%. If you have a 6% handle for agriculture growth, that gives a very strong overall backdrop for the economy. It contributes to stronger farm incomes, and stronger farmer incomes results in better rural consumption. So all of that, I think, is contributing and is likely to keep the momentum going into the next fiscal year. So if you look at India's direct tax revenue, right? Direct tax revenue, the final numbers haven't been revealed yet. They'll only be revealed at the end of May. But the indications that were provided to the media by the finance ministry suggest that direct tax revenue rose to 16.7 lakh crores, or 16.7 trillion rupees for the fiscal year 23, compared to an original budget estimate of 14.2 trillion. So a very substantial margin by which direct tax revenue outperformed the original budget estimate. That is only possible if nominal GDP is growing very rapidly, as it is, and real GDP also consequently is doing well because inflation is beginning to moderate. And if nominal GDP is continuing to grow 16 or so percent year on year, then you're going to get a pretty strong number for real GDP. So that coupled with the fact that GST revenues, if you look at GST revenues, they were up more than 20% year on year in FY23. That does not happen through an economy that is growing sluggishly. So it is clearly, I mean, all the tax revenue numbers suggest that the Indian economy has had another very strong year of growth, and I expect that a lot of that momentum will continue into the next fiscal year. Now, part of the reason why I am optimistic, why I expect the growth in the last fiscal year was 7.3%, at least, likely to be revised up later on, but let's say it'll start with 7.3%. And in the next fiscal year, we're likely to get another, the current FY24, we're likely to get 7.2% real GDP growth, well ahead of what the IMF, World Bank, and others are forecasting, primarily because the fiscal deficit is going to continue to be well below the target set by the government. In the fiscal year 23, the original target was a deficit of 6.4% of GDP. I think the final number is likely to be slightly below 6% of GDP. So when you get that stronger base going into the next fiscal year, the steps taken in the budget for FY24 would anyway have reduced the fiscal deficit by about 0.5% of GDP. So at a minimum, I would expect that the fiscal deficit in FY24 will be about 5.5% of GDP. And that means that the government's market borrowing will be reduced in investment is 1.9% of GDP. For FY24, I'm looking at a current account deficit of just 1% of GDP. So with FDI, net FDI inflows running at around 2% of GDP, and some portfolio inflows coming back as well, the external liquidity position will be very strong, and India will be very well positioned to outperform global growth. Now, I think it's just important to understand that, yes, this is a difficult year for the Western economies, particularly for the United States, the EU, and the UK. So those are economies that are likely to be in recession for the rest of calendar year 2023. But what's likely to happen for India is that services continue to grow. Services exports remain very strong. Goods exports have had a slightly difficult 6 months or so, but I think will be helped by the fact that in real effective terms, the rupee has depreciated about 5% in the last 4 months. And in fact, it's down about 5% year on year. That's very unusual. Most of the time, in real effective terms, the rupee is appreciating because India's inflation rate is normally higher than trading partner inflation, translating into even greater real effective depreciation of the rupee. So in real or inflation adjusted terms, the rupee is depreciating against its trade-weighted basket. And that is a very rare phenomenon. When that phenomenon occurs, it normally gives a fillip through exports, including goods exports. So I would expect that over the next 6 months or so, we'll get a better goods export performance. And that improved goods export performance, coupled with continued strength in the services exports, should ensure that the net export contribution to real GDP will be positive, year-on-year improvement. You have fixed investment spending continuing to strengthen. You have rural consumption picking up momentum in the next half year. So we get a really strong real GDP performance in the first half of FY24. And for the full year, growth is over 7%. So I think that will make India stand out in a world in which we have a likely recession in the US and a recession in the EU, particularly in some of the stronger economies in the EU, normally strong economies such as Germany. which Germany has basically taken a lot of pain by banning or severely restricting imports of oil and gas from Russia. More than half of Germany's energy needs normally come from Russia. So by choosing to join the United States' sanctions against Russia in full, Germany has suffered an economic contraction. And that painful period means that Europe is in trouble. And of course, India is not immune to that. I must emphasize that, of course, the United States and the European Union are very important trading partners for India. But that is why I think the RBI has done the intelligent thing by allowing the an effective depreciation of the rupee, by essentially ensuring that the rupee tracks the US dollar. The US dollar was strong between February and November last year, very strong. From the 5th of November onwards, the dollar has gone into a period of weakness. And since 5th of November, the Indian rupee has more or less tracked the US dollar. It's shadowed the US dollar. And so India's rupee is depreciating against other currencies, including competitor currencies such as the Chinese renminbi, the Korean won, the Japanese yen, etc. And that is contributing to better export prospects in the next 6 to 9 months.
So, as you spoke about the global economies, inflation has emerged as a major policy challenge, and we have seen the central bankers acting and increasing the interest rates sharply higher. In India too, we saw RBI acting and aggressively going in for rate hikes. But last policy, we saw a pause. Do you see this pause as a temporary thing, or it's a permanent thing to stay, and we can expect the interest rates to go down from here?
I don't expect interest rates to decline anytime soon for India, but I think the last of the rate hikes is over. And the key reason for that is that inflation is now moderating. We had an aberration for 2 months. In January and February, inflation picked up primarily because of non-PDS food grain prices. Non-PDS food grain prices rose quite sharply in January and February. They were up more than 16% year on year. They were still up in March. They were still up some 15.6% year on year, but they had moderated a little bit. Cereals inflation had moderated from the previous 2 months. And we had a broad-based moderation in prices across the board, in inflation across the board. As a result, the CPI headline inflation rate moderated to 5.77%, and that is essentially ensured that we should continue to see further moderation in inflation as we go forward. And with that moderation in inflation, there is no real need for the RBI to raise rates further. Now, India, of course, has a 2 to 6% target for headline CPI inflation, and January and February were bad months in which inflation was above the 6% mark. It's now come back down to within the RBI's target range for inflation. I expect that inflation will continue to moderate further. And the interesting thing is that we had a broad-based moderation in March, but we're likely to see a continuation of that. In particular, we're likely to see fuel and light, as well as transport and communications. The inflation in those two categories should be moderating significantly, simply because of a base effect. Last year, there was a big spike in those two categories because of the surge in Brent crude prices. Brent crude prices have moderated despite OPEC Plus's production cuts. There's been a moderation. There's been a very sharp year-on-year decline. So for the period from April to August, I would expect that Brent Brent crude prices will be down about 25% year on year. And with that, there'll be a moderation in fuel and light inflation, as well as transport and communications inflation in India. Okay. And that will ensure that there's no need to raise rates. As far as a rate cut, yes, I think a rate cut is a possibility, but probably not for another 8 or 9 months. Okay. Probably early in the next calendar year, perhaps January, February of 2024, we could see a rate cut, primarily because the momentum of the economy would probably have slowed. I think a lot of the momentum will be in the first half of the fiscal year. And as the momentum of the economy slows and as inflation moderates to perhaps below 5%, there'll be room for the RBI to cut rates. But that's still some way away. For now, I think the fact is that the US will be raising rates. I expect the US Fed funds rate to go to 5.5%, which is more than a 50 basis point hike from current levels. And even more than that, the European Union, the ECB, will have to raise rates even more aggressively because their target is 2% headline CPI inflation. They're currently at 8.5. The Bank of England has inflation in double digits, over 10%. So they are way above their 2% targets. Those central banks, I think, will have to raise rates even more aggressively than the Fed, and which is one of the reasons why the dollar is depreciating against its basket. I think even in Japan, interestingly, Japan has basically kept monetary policy extremely accommodative for 8 or 9 years. But now we have inflation in Japan at 4%. So with Kuroda-san has just retired after a very successful tenure as governor of the Bank of Japan. And interestingly, throughout his term as Bank of Japan governor, he was aiming for 2% inflation. He was not getting there. He struggled throughout his term. There was a brief period of about a year and a half during which inflation was at or just above 2%. But then now that he got a farewell present from Japanese prices, because Japanese inflation is now double the target. And so, given that, even though the new BOJ governor is signaling continuity in policy, what is becoming clear is that with inflation well above the 2% target, Japan is reducing the BOJ is basically reducing its interventions in the bond market, not addressing the yield curve as aggressively, and effectively allowing a steepening of the yield curve, which amounts to a quiet, effective tightening of monetary conditions in response to high inflation. So in effect, everybody else is tightening, even perhaps more than they were expected to, whereas the US is going to be tightening somewhat less than they were expected to a few months ago. And that creates an environment where the dollar is weakening. And, so a weak dollar is good for emerging markets, generally speaking. In addition, the RBI, I think, has been extremely intelligent in its approach by allowing the rupee to shadow the weak dollar, and thereby offsetting the negative consequences of the emerging recession in the United States and Europe, by ensuring that the real effective depreciation of the rupee allows India to gain some market share, even in those markets, and thereby mitigating the likely negative impact on exports of goods. Now, services, I think, are in a very sweet spot. India's services exports have done spectacularly well over the last 15 months or so, and I think will continue to grow over 20% in the year ahead.
So when RBI could do it, why is taming inflation such a big task for central bankers like Federal Reserve? I mean, what is it taking them, not so harsh steps to really contain inflation?
Yeah, I think I've been saying this ever since we started these talks in February last year, and the real reason is that the Fed has had an exceptionally rapid monetary growth period. During the COVID period between March 2020 and February 2022, you had M2 money supply growth in the US running at 18.2% average over that two-year period. If you go back 60 years, the average broad money or M2 growth in the US was 6.8%. So they were growing M2 for 2 years at nearly triple the pace of the average of the previous 60 years. In contrast, if you look at India, India's the equivalent of US M2 is exactly M3 in India. So India's M3 growth from that same period, March 2022, March 2020 to February 2022. Okay. During that 2-year period, India's average M3 growth was 11.1%. When you compare that to history, over the previous 30 years pre-COVID, India's M3 was growing at an average pace of 15.4%. So it was 15.4% pre-COVID. It was 11.1% during COVID. India was slowing. It slowed down monetary growth during COVID. And in the past year, M3 growth in India is averaging 9%. Latest month is 8.9%. So in fact, monetary growth has been very subdued during and after the COVID period in India. And so there isn't the same pressure on prices in India from monetary expansion that there is in the US and to some degree in the European Union. The ECB in March last year was promising to continue quantitative easing until October of 2022, at a time when inflation was already 7.5%. So I think essentially the European Central Bank was well behind the curve, and the consequences of that are now being felt. Those central banks were behind the curve. If anything, RBI was ahead of the curve. And inflation in India was primarily a supply phenomenon, not a monetary phenomenon. Whereas in the US, it was a monetary phenomenon, and they're now having to withdraw that monetary accommodation very aggressively. And the consequence is that interest rates are having to rise. But unfortunately, it isn't sufficient to bring inflation under control. The US has a 2% core PCE inflation target. The actual number currently is 4.6%. And it's been above 4% since October 2021. It's a long period of sustained high inflation, well above the target. So the Fed has some work to do. It's doing it quite aggressively now, but the ECB has even more work.
So do you see signs of transition to a low inflation regime in India when we are talking about deficit monsoon? We're talking about, there has been a statement from the FMCG companies that the rural demand has not picked up as expected, and they expect the volumes to dip further in FY24 as far as deficit monsoons is concerned. So how do you see inflation panning out for India, say, next 3 to 4 quarters, FY24?
Well, I think there are signs, at least I see evidence of a turnaround in rural consumption. In particular, you see it with the fact that consumer non-durables output is growing. Now, consumer non-durables output grew in double digits year on year in January, February. That doesn't happen unless there's a pickup in rural demand. So I think there is a pickup. It isn't very broad-based, but there is a turnaround. And we're in the early stages of that turnaround. And if indeed the Rabi harvest is as strong as the RBI expects, then that too will contribute to strengthening farmers' incomes and rural consumption. So now, the good news, of course, is that if you get a good harvest, that improves the inflation outlook. Inflation, prices begin to moderate. Now, of course, there are some apprehensions about an El Nino. We discussed that last month as well. I think it's important to understand that the El Nino phenomenon that the U.S. Weather Forecasting Service has also pointed to is likely to occur around August. Second half of August and September is when El Nino, when the waters of the Pacific will get warmed up by the El Nino. And when you get a warming up of water over the Pacific, that generally causes a drying up of the monsoon. And so the second half of the monsoon this year is looking a little bit potentially problematic. But I think it's also important to understand that IMD, our meteorological department, has forecast a near normal monsoon. They forecast that this year the monsoon rain will be 96% of the long period average. A private weather forecaster, SkyMet, has a forecast that's not too far. They are saying it'll be below normal, but it'll be 94% of the long period average. So we have two forecasters, one saying 94% of the long period average,
yes.
The other one saying 96% of the long period average. So let's split the change and say 95% of the long period average, which is just on the borderline of a below normal monsoon. Below normal is below 95%. Normal is 95 to 105% of the long period average. So, so we have, I think, if we get good rain in June and July, then most likely this will be a near normal monsoon, despite the El Nino phenomenon. And I think we've seen that previous El Ninos have had diminishing negative consequences on India's kharif output. So I would say that, there are some risks on the inflation front, particularly food inflation front, but India has adequate grain stockpiles, both rice and wheat, and consequently, if there is indeed a setback to wheat and rice output, there is enough in the granaries to distribute and ensure that prices stay well contained. So I'm not too worried about inflation this year. If anything, inflation is going to tend to be moderating. Of course, if there is some new supply shock, if you get some sort of big spike in the Russo-Ukraine war. Now, interestingly, the wheat growing areas of Ukraine and Russia are actually on either side of the border. On either side of the border, most of Russia's wheat is grown quite close to the Ukraine border. And it is basically the eastern Ukrainian part that grows wheat. So if there's an escalation of conflict around that region and a lot of crop destruction and all that, then possibly there could be some negative consequences. There could be another new supply shock from that war. But the baseline for me is that we had a lot of disruption last year. Compared to that, the high base of prices is unlikely to, you're unlikely to get a second derivative of inflation picking up in the months ahead. So I would say that the balance of probabilities is in our favor with regard to inflation moderating.
Let's move on to China now. Exuberance about China opening had fizzled out. But yes, the latest GDP numbers have surprised us on the higher side. Now, what will China's gradual recovery mean for the global economies and its impact on the inflation as such?
Well, I think the Chinese growth in the first quarter, 4.5%. If the world looks at a 4.5% handle for Chinese growth and says that this is worth celebrating, then I think we are in a different world. Of course, China last year, with COVID impact and so on, real GDP only grew 3%. So compared to that, this is a clear rebound. It's the Chinese economy has come back a little bit stronger, no doubt about it. Exports did very poorly in January, February, and then rebounded strongly in March. But the interesting thing about the March export numbers is that it was quite concentrated in a few products and in a few markets. China's exports to Russia soared. Exports to the rest of Asia did quite strongly. But exports to the US continued to decline. Exports to Europe were weak. So in terms of products, the single largest export product that had strength was steel. Now, I think that is something that we in India need to pay some attention to, because India is the world's second largest producer of steel. Last year, India imposed an export duty on steel for 6 months. From May to November, there was an export duty on steel and steel products, most of which have now been removed. Some of them are still in place, but most of the major items have now seen those export duties removed. But in a highly competitive commodity such as steel, if you impose a 15% export duty, then you lose market share. So India, I think, has lost some of its export market share, and China produces nearly 8 times as much steel as India does. India is the second biggest producer of steel in the world, but the world's biggest producer produces 8 times what the second biggest producer produces. It's a highly skewed global supply situation. But China, I think, has filled the breach created by India's absence from steel export markets, and that's a bit of a loss, I think, for India, and it'll be tough to regain some of that market share that China has aggressively gained at our expense. So now, in terms of the broader impact of China, though, I think that China is on the brink of a domestic and international financial meltdown of sorts. It's not quite a crisis, because it's not a concentrated event that brings the whole thing tumbling down at once. But it's a slow-moving, painful, evolving crisis. What I mean by that is 2 things. First of all, in March, China did see property prices rising 0.5%. There was a slight increase in property price. But I don't see too much prospect of property prices rising substantially more. And the month-on-month increase is still leaving prices quite a bit lower than they were a year ago, 2 years ago. And so the property sector is one area of extreme vulnerability, domestic vulnerability for the Chinese banking system. More importantly, though, we've had defaults over the last couple of years in Zambia and Sri Lanka. Argentina probably has just had its, or is close to having its 9th default in the last century. A default on its debt, sovereign debt. So a number of so-called frontier markets are in trouble. Mm-hmm. And the one characteristic that they all share is that the single biggest external creditor to all of them is China. So China faces the banking system, a banking crisis of sorts, both domestically and internationally, because mm-hmm. internationally, just like the US banks in 1990 or the Japanese banks in 1998 during the Asian financial crisis, Japan had the largest exposure to each of the 5 Asian financial crisis countries in 97, 98. The US had the largest exposure, by almost the main exposure of any banking system, to Latin America's debt crisis in the 1980s, which continued into the early 1990s. So just as the US faced the Latin American debt crisis then, mm-hmm. And in 1990, the Japanese faced the Asian financial crisis in 1997, 98. Now, 2023, 24 is the period of reckoning for China. China has huge exposure to the frontier economies, and it also has a domestic banking system that is extremely fragile because of the property sector's troubles. So while the economy cyclically is improving, the prospects are for a gradually evolving financial crisis to hit the headlines gradually over the course of the next couple of years.
If that's the case, how worrying is it for the global investors, and why is it that they're not coming to India and going to China?
Well, first of all, I think they're beginning to come back to India. In the month of March and April, yes. We've seen some FII flows coming back. Now, at the beginning of the year, always there's a reallocation of portfolios, and when you look, mechanically at valuations, India looks very expensive relative to China, and that's one. Second is that China has a much higher allocation in equity indices, such as the MSCI index. China has a substantially higher weighting. And when portfolio managers look at their weights relative to the benchmark index, at the beginning of this year, they would have noticed that, hey, we are extremely underweight China relative to the benchmark. And we are generally overweight India relative to the benchmark. So if we are overweight India and India's valuations look, much more expensive relative to China, then there's an almost automatic knee-jerk reallocation at the start of the year. And that's essentially what happened. So January, February was just that reallocation trade. And then reality begins to strike, and you get a round of earnings announcements coming out, and you begin to realize, and investors began to realize that, well, despite the fact that India has, India's valuations look somewhat stretched relative to others, they don't look that stretched relative to India's own history, partly because the earnings growth remains robust. So earnings are generally doing well for India. Most of the Indian economy is seeing, most Indian companies are reporting solid earnings. Of course, there are a few disappointments, Infosys and TCS among them. So the software sector is one area of slight disappointment. Again, it's very slight. And a lot of the disappointment is in constant currency terms, etc. But at a time when you have uh, uh, rupee depreciation in nominal and real effective terms, uh, you know, companies report their earnings in local currency terms, and the local currency actually is not that bad. Local currency performance, even for those, is not that bad. I mean, it's a little disappointing relative to the expectations and their guidance, but otherwise nothing particularly bad. But broadly speaking, the overall EPS growth remains strong in India, partly because nominal GDP is growing strongly, real GDP is growing strongly, and that contributes to better listed company earnings performance. So all of that has helped, and so we're beginning to see that India is seeing FII flows coming back. Now, if you look at China, valuations are always going to look cheap because a very large chunk of the so-called, the MSCI index for China includes A shares. A shares are basically China has different classes of shares on international markets. You have B shares listed in Shenzhen and Shanghai, where there's international auditing and so on. Then you have H shares listed in Hong Kong, where you have international quality supervision. So B and H shares are at least somewhat more investable. A shares are listed domestically in China, and until a few years ago, until 5 years ago, nobody, even researched them, or most international investors did not look at those shares. But somehow MSCI, the index making body, which is Morgan Stanley Capital International, MSCI, chose to include A shares. I think they began to regret it quite soon. But once the decision is made, once they said that A shares are investable and they are liquid enough to be listed, the weight for China increased very substantially, and the weight in the MSCI index is overwhelmingly high, and so China naturally attracts. Most fund managers track an index, and they move according to that benchmark index. So if the benchmark index has a big weight for China, they are perforce obliged to have a substantial weight or allocation for China, and that's essentially what has ensured that China, especially in the early part of this year, has had strongly outperformed India until the reality began to strike, and it began to become clearer that India's economy is in pretty robust health. And I think it's worth just re-emphasizing why India is in robust health. I told you about my growth forecasts, but the reason why India's economy is in such good shape is that the external liquidity position has improved dramatically. But that's true of China too. China has a current account surplus, so external liquidity is strong. But the interesting thing is that China has a trade and current account surplus, but its foreign reserves have been declining, which suggests that even though the current account is in surplus, a lot of money is being taken out. There's a lot of capital outflow, capital flight from China, which means that the locals are not too confident about the Chinese economy. Now, some other factors in India. India has deleveraged internally and externally. So if you look at the external debt to GDP ratio, in 2014, March 2014, it was 24%. As of June 2022, the latest number we have, It's down to 19%, and most likely it has declined further from that. So external debt is low relative to GDP. Then look at internal. Credit growth was very moderate, just 9% annually for 8 years. And now, finally, in the 9th year of the Modi government, we're finally seeing the cleaned up banks, the strengthened banks beginning to lend after a long period of very, very slow credit growth. Credit has picked up in the past year. We now have 14.8% credit growth. And that is possible primarily because banks have deleveraged, corporates have deleveraged, and they've cleaned up their balance sheets and now are in much better shape to lead a recovery in bank credit. So it's all good. I mean, I think, as I said last time and the last couple of times, there's one area of weakness for India, and that is the continued weakness of labor-intensive manufacturing and labor-intensive exports. If that can be addressed, then India can easily do,
Shukla has posted a question.
But as China gets into financial trouble, I think it does create an opportunity for India. The main type of opportunity it creates is that with China's banks very troubled, apart from all the other things, there's also the local government financing vehicles, which depend on rising property prices to sell land. The local governments used to sell land and use that as the main source of revenue. That opportunity has vanished in the last couple of years. So there will be problems in the Chinese financial system pretty much across the board. And that will constrain China's ability to ease monetary policy and boost further capacity expansion, which means that there is an opportunity for other economies, especially India, to have a capex revival. And in fact, my argument is that for the last 6 quarters, we've had a revival in capex. It's been led primarily by public investment spending, but I think private investment is also beginning to kick in. Capital goods output in the first 11 months of FY23, capital goods output was up 13.4% year on year in real terms. Capital goods imports were up 12% in the fiscal year 23. So all of that suggests that we are seeing a recovery in investment spending, which will gather momentum as we go forward, because China is constrained from continuing to boost its industrial capacity any further. It already has overcapacity. So the fact that in the year to date they've increased FAI, fixed asset investment, by 5% is actually illogical. They should actually be contracting investment, but they probably won't do that until the banks are really in serious trouble, which will be, I think, over the next year and a half, 2 years. It won't happen all of a sudden, because the Chinese will continue, the government will continue to try to rescue various parts. They've lent $240 billion to the frontier economies that are in trouble in the last 2 years at 5% interest. Much more expensive credit than those countries could have got from the IMF. And they've also put out another $260 billion line of credit to the 14 largest property developers in China. So they're trying to do what they've always done, which is whenever in trouble, throw some more money at the problem. But the aggregate amount of money cannot be increased. So they're throwing more money at particular sectors, including external and domestic. But the aggregate amount of money cannot grow too fast. If that happens, money will start leaking out of China. There'll be larger capital outflow. So I think there is now a good opportunity for the rest of the world, including India, to lead an investment revival. And frankly, if India got its act together on the labor-intensive manufacturing, that would be a big area where India could gain a lot of market share from China. We only, our exports of textiles and garments are only 1/9 of China's. So if we get our act together in labor-intensive manufacturing, then, we could try and capture 1/3 of China's exports of garments and textiles over the next, say, 4 or 5 years, and that'll triple the amount of exports of textiles and garments from India. So that sort of opportunity exists. I'm not yet confident that we will fully take advantage of it.
Okay.
But the labor reforms have been passed. What's now needed is that they need to be implemented, and we need Indian companies to respond, either Indian companies or the likes of IKEA. I mean, I noticed in parts in Bangalore and Mumbai, etc. We're beginning to see large IKEA outlets. If IKEA comes in and does large-scale procurement from India, or if we start seeing Walmart doing large-scale procurement, or H&M doing large-scale procurement from India of textiles and garments, that too could work. Ideally, of course, we'd love to see Indian corporates leading the way in labor-intensive manufacturing, and if they do, then we're really off to the races. But at the moment, as I've said the last couple of months and said today too, labor-intensive manufacturing is not responding yet.
Quickly, one more question. Which sectors are expected to do well in the next month, sir?
Well, I would say that the banks should continue to do quite well. We have a stable interest rate environment, no real increase in interest rates coming up. So I think the banks will be one area of strength. We have both credit picking up, so top line growth, as well as stable to slightly improving net interest margins. So I'd say the banks and non-bank financial companies should be doing well. I'd say the pharmaceuticals too are another area of relative solid possibilities, and I think the automobile sector, cars, auto components should be doing well.
Thank you so much, Mr. Basu, for being with us. I appreciate your time, sir.
Thank you very much. Thanks, Gitu.
I would like to remind our viewers that please do subscribe to our YouTube channel, and please post your queries in the comment section below. Also, let us know any other topic that you want us to take up in our coming sessions. Thank you once again for watching.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.